A very good morning, all of you, once again. Yesterday was a very well-held session yesterday. Sessions yesterday were very well received. The feedback that we received was excellent. We are very encouraged. The products that we showcased have received fantastic feedback and reaction whatsoever, whether offline, and that makes us that gives us more inspiration. Today we have certain presentations lined up, first of which would be a presentation around risk management. Like we mentioned yesterday, risk management is an element that we take very, very seriously. I think that is sufficient. We have institutionalized that the institutional risk management at 2Cents Capital is taken care as a second layer of guard and second layer of safety net to protect any investments that we do. Now I would request our risk management team, Gaurav, Valunj and Avnish, to give you a glimpse on what they have been working on and how it's beneficial to the products that we have. Thank you very much. Over.
Thank you, Priyesh. So good morning, everyone. We are financial due to improper risk management foundations. Imagine that you are driving a car and car don't have any brakes. So this is what it's like to trade without proper management setup. So what separates those 5% traders from 95% traders who are profitable? We will see how we created risk management at 2Cents Capital and how it can. For those who don't, I am Gaurav Valunj. I have done my BTech from IIT Madras and I joined 2Cents Capital as a risk analyst. And joining me, Avnish Kumar, who is also a BTech from IIT Madras and is also a risk analyst at 2Cents Capital. And along with us, Sumit Deshpande, computer science major, and is also a risk analyst of 2Cents Capital. So why manage? So here is a simple illustration. As you can see, if we have, let's say, a loss of 7%, then the amount of money that you will need to recoup that losses will be around 7.5%. Once you get out of this 7% zone, it will be much more hard. A solid framework to manage risk at 2Cents Capital. So 9 months back, when we started to develop framework at risk, to start FRM into different verticals. The first vertical is trade risk management. In this, we design mathematical models for risk management. On the trade level is level portfolio optimization, diversification, and rebalance of our portfolio. So hedging is like basically taking offsetting positions to manage our losses. Or third at FRM is return. So as the name suggests, in this we find the stock rising or falling by certain percentages, certain periods of days. We also fourth vertical is scenario analysis. So scenario analysis is mostly neglected by a lot of traders. So we focus on scenario analysis. In this, we consider different kinds of hypothetical or historical scenarios, and we will see what will be effect on our portfolio due to those scenarios. So let's say, what if Donald Trump wins again? What will happen to our portfolio? So this kind of scenario analysis we do at 2Cents Capital. It is an extension of scenario analysis in to our portfolio during those extreme events. Let's say like, what if COVID-19 comes back again? What will happen to our portfolio? Models at 2Cents Capital.
Borrow. All these models. First, we start with our objective. That means what we need to solve. We need a hedge. Research papers, optimal solution for our problems. Once we get solution for our problems, we move on to development of mathematical models from our solutions and code it in our trading framework. Once it is get deployed in our system, we move on with a backtesting. Figure out what all possible conditions where my model can fail. Once we get pointers where my model can fail, we go on and do refinement of our model and do some calibration to mitigate all the problems in our models. Once we are sure our model is good enough to go for live, we go live and do monitoring and reporting on a regular basis. Figure out if we do need to do some adjustment due to we do iterative improvement that we become more dynamic and adjustable to market conditions. So let's now move on to models we are developing at 2Cents Capital. One of the trade level model is position sizing. So you may be interested in be decided accurately before you go on solid curve and there is dotted curve. Most of the models which are developed conventionally are based on dotted curve, which this model cannot able to capture extreme market events. That means if market too much or down, it will not able to capture that movement. Instead of using this, we use Pareto distribution, which is the solid curve. You can see that it is better adaptable to the market conditions. So based on this distribution, we find out what is the value at risk at any particular trade. So based on that, we decide our position sizing. If you look over the table below, you can see that if the value at risk we get is too much high, we will position size it less. Means if you have high probability of risk, then there is possibility that you can lose more, so we will position size it less. If the VAR is less, we will position it more. Let's move on to states which you don't know. You don't know market is going to be bullish today or market is going to be bearish today. So based on this model, we try to predict what's the probability of market going to be bearish or bullish. If you look over, saying go long. Go long means what? It's expecting market bullish, but we will apply our hidden Markov model and see if the market is going to be bullish. So we get a double check on it. If real that market going to be bullish, we'll position size it more and gain more from it. But let's suppose signal is long and my probability model is saying no, the market is not going to be too much bullish, then we position size it less because we don't know actually the market is going to be bullish or bearish. Similarly for the short positions, we double our positions and then we take how much to trade. And now I will pass it again to Gaurav. He will explain more about trade management models.
Avnish. So trade management models are mathematical models in which we determine when should we exit the trade when the trade goes against our favor. So let's look at some methodologies that 2Cents Capital to design management models. So volatility based trade exits. So as we see in the table, if volatility is high, we should put the level at a larger distance so that probability of hitting the stop loss will be less. And if the volatility of is less, then we will put the stop loss as important in trading. So how to find this volatility? What are the factors? Historical volatility, implied volatility. So by using this, we calculate the volatility of the stocks and we place the trade exits model according to that. So let me of some simulation based trade exits model. So this is optimal stop using Marcos, in which we use simulations to determine the for that strategy. Let's say A and B. After assuming the strategy, we will model the profit and loss for that strategy. We will define this utility function such that it matches our objective. Our objective can be anything, whether to maximize the return or to minimize the drawdown or to maximize the Sharpe ratio. We will define some utility function. So after defining that strategy, hypothetical scenario to the effect on our portfolio. So, since capital, we deploy 3 types of scenario analysis model. The first one is historical scenario analysis. So what we do in historical scenario analysis? So in this, we replace past. Let's say like 2007 to 2008 oil price rises. So if the similar condition will occur in today's market condition, what will happen to our portfolio using current exposures? So we have different kinds of scenarios in this module, and we will see what will be effect on our portfolio due to those scenarios. The second module is macro financial scenario analysis. So macros are basically the economical factors such as GDP, foreign investment, government policies, and we will see if in future time, if the macros are being affected or being shocked, what will happen to our portfolio. Let's say if the GDP of India will happen to our portfolio. The last one is simulation based or market driven scenario analysis for stress testing. So in this, we run certain kinds of Monte Carlo simulation using different methods to determine what will happen to our portfolio in extreme conditions. So I would like to pass on to Avnish to explain you how we do hedging at 2Cents Capital.
Thank you, Gaurav. Now let's move on to hedging. It is one of the most important aspects for any hedge fund. So let's first see what is hedging. Quant long-term hedging. One is high hedging cost, because hedging using effective and leads to portfolio drag in a normal and bullish market conditions. Because if you hedging with traditional method, it only protect you in down market, and if it's good or if it is bullish, it will create a portfolio drag for it. Bullish market. So let's see one of the literature review of one of the model. If you look over the graph, you can see that we have made 3 different portfolios. One portfolio, which is light colored curve, it is uninsured index, means no hedging has been done. If you look over the blue curve, it is portfolio which is hedged by our method, and the dark color portfolio which is hedged using conventional method of hedging. So what we are utilizing here to get so much good returns from our hedging. So what is market correlation? Market correlation means how much stocks performance is dependent on the overall market. If the market are good or in state, the correlation between market and the stocks are generally very low. Stocks perform independently to the market. But when the market conditions are not, we are utilizing this concept to make a hedging model. So if you look over, people do hedging using index because it replicate more to a market. But if you look over in bad market conditions, because due to significant increase in correlation of stocks to the market, can actually utilize portfolio of stocks to work similarly as an index. So we are utilizing that concept to make our hedging model. One of the edge of this is thank you. That's all from our side. But we are not just here. We are not. This is not the end of our work. We are going ahead to develop risk models for every trade level, for every portfolios we are developing in 2Cents Capital. We are more robust systems doing and other advanced models so that we can be better equipped in an extreme market conditions. So that's all from our side. It's nice talking with you all.
Well, that was very brilliant. That was a brilliant presentation, Gaurav and Avnish. Next presentation will be by the team, the futures and options team at 2Cents Capital. We have a dedicated 6-member team who dedicatedly work on derivatives and using derivatives to take trades. So they are quant derivative traders, and they're going to present 2 strategies that they have developed and deployed and which are generating decent returns.
Quant derivative division, derivative analyst, sounds something fancy, right? Basically, I'm your go-to futures and option guy. Now, what is future option? अरे लेक्चर तो आए हो, सीधा फायदे की बात करते हैं. चाहे मार्केट ऊपर जाए, नीचे जाए या साइडवेज रहे, we have 2 jobs: to generate return and protect portfolio. Sounds cool. Why it is important and how it connects to you. Imaginable. If you can sketch it or describe it, you can design a derivative to match that vision. Derivatives are the all-rounder of the financial market. of the financial market. They provide flexibility, leverage, and risk management. As I said, market up, down, or sideways, you can profit from any market condition with the right strategy, of course. Leverage, you can have a greater market exposure with a very minimal capital exposed. And the derivatives are the best hedgers as they not only protect your portfolio, but also market are full of villains like inflation, global tension, rate hikes, and of course, volatility. Now, what is volatility? Think of it as market का mood swing. कभी बहुत खुश तो कभी unexpectedly उदास. For most people, it's an problem, but for us, it's an opportunity. But how it's an opportunity? Let me tell you how we leveraged volatility to create an alpha. We divided market into mainly three sentiments: volatile, non-volatile, fluctuating, and created a module which consists of all these three market conditions and a fixed income, low risk strategy. Here we aimed for a superior adjusted return. Before going to a strategy, let me tell you how we came up with this. The over we have been working on a definition. Uh, 6 phases based approach where paper deployment and live deployment. Now, let me take you through each step. The first we did before getting a strategy, we went through research papers, articles, blogs, and live experiences. But did we find only strategies? No. We also got the personalized risk management for each strategy. Backtesting. This was to test each strategy in the every market scenario. Here, we found out the threshold for each strategy deployment and got the most optimal it for the strategy. This strategy is, as you can see, this has not performed but has exceptionally performed in a non-volatile years. But was this strategy most optimal? We don't know. So we have permutation and combinations of variables and the thresholds. Next strategy was IV rank strategy. So as you can see, this has performed exceptionally well in the volatile markets, but has not given much returns in non-volatile years. But the major threat to this is IV. But the sudden drawdown in the volatile process, after a deep research, trying many permutation, we came up with a threshold of 75 percentile of 3-month volatility. Once market crosses this number, we squared off our position, and as you can see, the returns are very well, and max drawdown is also quite low in the volatile years. Now, let me take you through the strategy which is designed for fluctuating market. This strategy is designed for scenarios like COVID announcement, post events, etc. Here, the trades taken are quite low, but whenever it takes trade, it has made it money. But why only IVHV rank? Why not Z-score, correlation score, co-integration score? Yes, we backtested all of them and found IVHV rank serves our purpose. The next step was to blend all the strategies. We blended all of them and found the strategy perform exceptionally well in every market condition. It has performed well in volatile, non-volatile, as well as fluctuating markets. But does backtesting depict what we actually see in the real market? We don't know. So we went to the next phase called forward testing. Here, we assess the performance of each strategy in the live market, real-time markets simulated data. Here we assess the performance in a controlled environment, refined risk parameters, and tested adaptability to live market dynamics. And using various machine learning models like SVM and K-means, we found out how it works. As you can see, the returns from forward testing are quite similar to what we got from back testing and gives the good returns. The next step was optimization. Here we optimized and fine-tuned every strategy parameter according to current market condition. Here we ensured our trading framework are both efficient and resilient. The next step was paper account deployment. Here we deployed our strategies on the paper account in live market conditions without any capital at risk. We tested our execution system, risk management framework, and reporting. This step provided us confidence in operational readiness of our system and ensured seamless integration with live trading platforms. But does paper trading market? We don't know. So we deployed all these strategies and in real market and found out, yes, and what finally we got, yes, these strategies performed exceptionally well in every market conditions and has given us good returns. But from so many time I'm talking about this strategy, how it works, that strategy, how it works. But let me take you through how a strategy has been built. Let me tell you the strategy which was built for non-volatile market conditions, IV slope strategy. अरे IV slope ऐसे ही नाम दे दिया, वैसे भी नाम में क्या ही रखा है. This strategy is mainly designed to eat the theta decay, the value which an option loses over time. This value is taken by an option seller and lost by an option buyer. Simple, right? Why don't we then simply buy and sell an option and get that decay? But selling off that option comes at cost. Selling off that option comes at cost of possibility of infinite loss. And if we keep buying the options, we will be constantly losing time value. To come up with this problem, we came up with a strategy called calendars. Here, it has properties of a short option as well as long option. It consumes the time decayed value as well as has no possibility of infinite loss. But can we trade this randomly? No. We have to take very informed decision and very keen signals. For that signal, we developed a variable called IV slope. Using various, we went through various research papers, rigorous groundwork, and came up with that variable. But the initial results were similar to something like this. It performed well in the non-volatile conditions, but the results were not what we actually expected. So after a deep research, we found out the biggest problem was gamma squeeze. Complex market scenario, which I know no one is expected to, no one wants to know. But yeah, that's our job, to study these scenarios and exploit them. Yes, we studied these scenarios and found out how to exploit these market conditions. And with deploying that, we optimized our result. And as you can see, it has performed exceptionally well. And the CAGR, the returns has increased as well as drawdown has decreased a lot. Yes. Whatever profit and loss we got in backtesting was not what we saw on our brokerage account and all. So, but why this happened? Let me take you through how we were fooled with various false Greeks we saw in the market. So whenever we took a volatility trade, it showed us some Vega, but we never got that PNL after changing that volatility conditions. That was some scenario of false Vega. We researched on that and found out the brokers don't consider various market scenarios like weighted Vega, volatility mile, volatility skew, and time to expiry. We researched on that and found out and came up with a solution called weighted Vega. Think of it as ripples produced in a pond. It's like short-dated options which are highly sensitive and close to the point of impact. And the long-dated options which are having low sensitivity to current expiry are very similar to points which are distant from a point of impact. And we came up with a formula called weighted Vega. The next scenario was skewed Vega. Think of a seesaw. As you know, the impact near the pivot point is quite low, but the impact near the extreme points are quite high. This is the very similar scenario which we saw in the volatility smile conditions. We implemented this theory and came up with a new Vega called skewed Vega. After integrating weighted Vega and skewed Vega, we came up with what is actual Vega of current market. The next was delta. Delta, what we see is basically change in market price with respect to change in option price. But does delta depicts this simple thing? No. Delta is affected by volatility, change in strike, as well as Vega. We considered all of this term and got with a new delta called mean variant delta. The next was delta theta ratio. This ratio is designed to manage every calendar which we trade. This not only makes profit, but also makes adjustment which are very precise. And the next is how we limit our risk. Daily, we have 2% risk. Once this stop loss is hit, we close our trading books and take no trade. Weekly, we have 5% the risk limit, and monthly the risk limit is 15%. But does it sound cool to have a derivative trading division and having simple stop losses? No. We didn't use that, but we came up with our own stop loss system, which is capping of Greeks. We capped the Vega for 2%, gamma 2%, and volatility 2% each day. And the results which we got from this capping were quite fascinating from what we used to do with simple stop loss methods. Thank you, that's all from me. The future plans are what we are to deploy similar for 3 more modules for every market conditions. Thank you.
Thank you, Abhinav. Thank you, Abhinav. Good morning. Hi, and welcome to our 2 Cents Alpha Plus Fund. Thank you for taking your time to meet us today. Before we begin, let me wish you a very happy Republic Day. Let's meet the team. We are a team of engineers brought us together by our common shared love for finance, especially derivatives. So why options? The US markets have seen a phenomenal rise in daily options data contracts starting from 2020. So we are making use of these increased liquidity in the markets. This rise in market liquidity has been comprised mainly because of 3 factors. Market volatility. Investors are seeking strategies that provide them with risk-adjusted returns plus diversification. Institutional adoption. Hedge funds, pension funds, and other institutional investors are diversifying the portfolio using options and also seeking risk-adjusted returns. Retail participation. This has been really a game changer for the markets. Platforms like Robinhood had brought in millions of individual investors who put their money in the options market, and then it causes liquidity to improve, thereby creating a fertile ground for hedge funds and other
थोड़ा नीचे रखो, चिन में मत सटाओ, थोड़ा नीचे रखो. There is a shrill here. Yes. Just don't close.
Due to this increased retail participation, there have been increased in liquidity, which creates a fertile ground for hedge funds and other institutional investors to test out their systematic strategies. Recently, the markets have seen uncertainty and volatility, and this has become a norm. Recent shifts in interest rates, coupled with geopolitical shifts, wars, have caused widespread panic among investors. In these markets, seeking risk-adjusted return strategies with growth has been like moving in uncharted waters. That's why we come in. We provide a data-driven, disciplined approach towards options trading. Let me share you how we do it. We provide proven strategies. We do technology-driven analysis and active risk management. Let me give you a brief of that. For every market scenario, let it be bullish, bearish, or sideways, we deploy tailored option strategies. For example, our iron condor strategy provides income generation in the low volatility as well as high volatility markets. We scan thousands of trades to find out the optimal entry and exit points for our strategies. We also track implied volatility on a real-time basis, historical volatility, to find out exact thresholds for our strategies. We do active risk management. We input real-time data. Using that, we calculate the Greeks. Then we take that as input to the strategy. Once the strategy has been put to implementation, then we monitor the strategy Greeks as well as its active P&L. Based on that, we do live risk management based on Greeks. Let me talk about a brief of the strategy we have deployed, that is iron condors. So why iron condors? Iron condor is a strategy where we simultaneously sell a puts and a call spread, making it most advantageous when volatility is high. Let me talk about the three phases of volatility: volatility lull, volatility expansion, and volatility contraction. These three phases are defined by the ranges of volatility. For example, it has been found in research that volatility has been showing a mean reverting behavior. So volatility lull revolves around its mean, with volatility lull and contraction contributing 90% of the total volatility curve. We can make this strategy use of this phenomena and make use in our strategy. Let me show you how. So as we have seen that iron condors have already been discussed, that it is better in when the implied volatility is high. So does that mean we cannot deploy it in the low volatility markets? Let me show you some example. Right now, the market volatility is hovering around 13. This is a VIX fear index. We conducted two quantitative studies, and in that we took IVR rank of 25% as the threshold. Above 25% IVR, it was decided that it will be categorized as a high implied volatility market, and below 25 percentile rank, then it will be a low implied volatility market. We deployed iron condors to test our hypothesis. So we bought iron condors with in SPY with SPY 45 DT days to expiry. The wing widths were selected as $5, $10, and $20, as well as the short strike were put at 25 deltas. As you can see, we have plotted a chart wherein we describe and compare the win rate and monthly ROC and monthly volatility of the different scenarios. It is quite evident from the chart that wider iron condors have outperformed their narrower counterparts in win rate as well as monthly ROC and monthly volatility. Wider iron condors in the high implied volatility market provide better returns as well as greater control over volatility. But it is worth noting to see that the same strategy, when deployed in the low volatility markets, has also performed considerably well with slight reduction in monthly ROC, but in the control of volatility is maintained. Not only this, we also conducted a study wherein we tested our iron condor strategy over bear and bull markets. So the chart you are seeing right now shows from January 2006 to January 2024, there has been a total of 6 major drawdowns. We tested the performance of iron condors in the bear and bull markets. As we can see, the wider iron condors have done really well in the bull markets. But in the bearish markets, the narrower counterparts took the show. In the bearish markets, the narrower wing iron condors provide greater control over volatility, better win rate, and monthly ROC. With that, I will ask my colleague Avnish to start with the strategy development and risk mitigation procedure. Thank you.
I hope you may be interested in knowing how do we develop this, because we have talked a lot more about this strategy and we have talked too much about why we are using and why this is very good strategy. So let's now move on to how do we develop strategies as 2Cents Capital and how we mitigate risk involved in our derivative fund. So if you look over the market behavior and the perception of people, you will find that there is some discrepancies in them. If you look over the monthly returns on 3 different dates, these are just recent dates, you will find that this is purely stochastic in nature. There is no correlation between 3 different dates. But instead of, because this is so much stochastic, we don't work with predicting market direction. If you look over the price limit returns, because people are very good at finding patterns in the charts, they try to find patterns in the price movements and try to predict where market is going to be. But instead of working with predicting market direction, where market will go and we make profit on it, we work with a range-bound trading. So instead of predicting, we work with probabilities and range intervals. If you look over the chart here, you can see that we have developed a band. How we develop these bands? We have developed one of the quant model for developing these bands, which take into account implied volatility. It takes current price and takes options Greeks to find out what is the probability of market to be in this range band in upcoming 5 to 7 weeks. So based on this range band, we do our range-bound trading. But it is not the end of the story, because market can go unfavorable to us any time. So we always have real-time risk management in place so that we can exit our positions in an unfavorable market conditions, and we do band adjustments to reduce our losses whenever market goes unfavorable to us. If you look over the graph shown here, we have closed our earlier positions and make new range bands. So why we are doing this? So based on our quant models, whenever price moves too much close to our band, we just close that positions and take new positions based on our quant model. So it helps us to reduce the risk of loss due to higher delta, and it also helps us to reduce Vega exposure on our strategies. But it's not only that we reduce losses on our strategies, we also take opportunities from the market to gain more premium. If you look over the second graph, you can find that we have adjusted our band and make it inward. So we do these things. Let's suppose we have taken initial bands and market goes unfavorable, that due to which we need to shift our band as soon in the first graph. But after some time, it is possible it come back to its initial band. So we will adjust our previous positions to a new positions which is in, so that we can gain more premium and make more profit for our AUM. But it's not only the strategy we are doing. There are many more things going on to having a profitable strategy instead of having just a single strategy. So in any strategy, we work with position sizing models, we do trade adjustments, and we exit to make profit on our strategies. But is it really position sizing matters? Let's see one of the example on one of the basic strategies, not ours. We will tell our backtesting results later. If you look over the graph, you can see that if you take 10% risk per trade, you can find that the CAGR is 2.1% and the drawdown is just 2.4%. But if you take 20% risk per trade on this strategy, you can see that the CAGR is minus 10.3% and the drawdown is 12.6%. So just only changing how much amount of money you are investing, there is a 12% drawdown in your cumulative profit. So position sizing is very important. If you don't position size it properly, there is possibility even if you have very good strategy, it can become disaster for you. So now you may be interested in knowing and take something from this presentation to your home so that you can also make a very good profitable strategy. So we initially divide our fund AUMs into 3 different indices. How we choose indices? Our indices are basically chosen based on correlation. We choose just 3 less correlated indices so that if our strategies go bad on one index, this does not affect the performance of our strategy on 2 different indices. On each indices, we have different strategies. So for that, we have our position sizing models, which allocate amount of money should be invested in particular strategies. Then we go on and take our trades on it. After taking trades, it is possible market goes purely favorable to us and we will take profit and get out of the market. But it is also possible market didn't go as we want, it goes unfavorable and we need to do trade adjustments. So we did trade adjustments and then the take profit level reached, then it's okay, we will take the take profit, exit from the market. But if profitable or we didn't reach the profitability we wanted, then we will hold till the expiry so that we can gain the maximum TKRK, reduce our losses, or if possible, we can gain from it, and then finally we exit our position. So this is the overall framework from initiating our trades to ending our trade. That's how we work at 2Cents Capital. But it's not all. There are some risks associated with it. As every financial instrument has some risk, do the derivatives fund have. It's basically have 5 different type of risk involved in it. We will go one by one. One is the tail risk. What is tail risk? Tail risk is basically when the market goes too much bad or too much good, which leads to high losses. This is known as tail risk. So we have 3 things in place to mitigate this risk. First is adjustment. So whenever the market goes too much bullish or bearish, we adjust our trades, means we close our earlier positions, take new positions, so that we mitigate the risk of losing money on initial position. Then we do tail risk insurance. What that means? We generally work with a deep out of the money options because it's too much far from the current market price. It generally accommodated all of the tail risk involved in it. And then we have hedged position. For every short position, we always take a hedged position against it so that the losses get capped. It didn't lead to more losses than what we have decided initially. Second type of risk is volatility, or you can say it as volatility spike. So one of the things we do, we just roll over our positions to next expiration date to gain the premium due to rise in the volatility, due to sudden spikes. We try to gain more premium utilizing that particular conditions, and reduces our loss on initial position. Third type of risk is gap risk. Gap risk means a sudden upward or downward movement in the market. So because we work with 1 to 1.5 standard deviation bandwidth, generally maximum more than 90% of the times, market remains in between 1 to 1.5 standard deviation in upcoming 1 month. So it's mostly get accommodated in that, but if it goes out of 1.5 standard deviation, we adjust our trades to get it range bound again. Then other type of risk is liquidity risk. Because we work with one of 3 most liquid indices on US market, it doesn't, we didn't care much about liquidity. But to double check, we also look over the open interest before taking any short positions in the market. And there is the concentration risk. What is concentration risk? Concentration risk means most of the money is allocated to any particular strategy or any particular indices. So we diversified our portfolio. We have multiple strategies, and we trade on different indices. That's how we mitigate this concentration risk too. That's it. Now I will pass it to Pranay Gaurav.
Thanks, Avnish. Now let's explore the performance of the strategy. So these are all the strategy theoretical that Avnish and Somadeep told. So how we judge the strategy is good or bad? It's only with the performance only, correct? So now explore the metrics one by one. So strategy, the backtest run for 12 years, 2012 to 2023, and it gives a CAGR of 22.4%. So compounded annual growth return. So this shows that strategy is good for long-term performance. Strategy gave a Sharpe ratio of 1.2. So Sharpe ratio, this is the returns with adjusted risk proof, and also it is showing that the strategy is giving upward volatility and downward volatility. It is performing good. So same way, the probabilistic SR, that is 87% if you see. So this shows that the strategy is highly confident, showing in the terms of Sharpe ratio. So in the probabilistic SR, we see that a strategy is overfitted or not, because sometimes what happens when we backtest, so due to the overfitting, some Sharpe ratio increases very fast, and this disturbs the strategy flow. So like higher the probabilistic SR, higher the confidence in the strategy. Now go to the number of trades. So the number of trades is 0.3, which is close to 10 trades in a month. And now explore the drawdown. So this is very important part of the strategy. So when we are running with the initial capital, when the strategy is running, so from the peak, like the profit, from the profit, how much it has gone given loss. So higher the drawdown, it is difficult to recover from that loss zone. So here our strategy gives a drawdown of 14.8%. So lesser the drawdown, so it took less time to recover from that zone. So now explore the performance of the strategy monthly wise for each year through a heat map. So with this chart, if you see the red ones for each year in a month, the red ones are the negative returns, and the green ones and the yellow ones are the positive returns. So for each year, for each month, the red cells is not repetitive in nature, neither consecutive. So this shows that strategy is most of the time profitable in a year, with sometimes it giving negative returns, but it recovered so fast. So further months are greens and yellow ones, that is positive in nature. For example, 2023, for January month, it is giving negative return. But for further months, continuously it is giving the green cells, if you see, the positive returns. Only the September month and the further months, it gave the negative. So most of the time, it is in profitable stage. With this chart, we can come to the conclusion. Now go to the returns, annual returns of the strategy for a year, how much it is giving for the capital. So here the return distribution, if you see, from 2012 to 2023, so the highest it gave for 2023, that is 42%. But on an average, with the red line, if you are seeing, so it gives 20% on an average return. So from this we can see the strategy is consistent with the return distribution also. So sometimes higher, most of the time 40%, 30%, but on an average it is also going good with 20%. Now going to the next further metrics of the strategy that will evaluate how strategy is good or not. So benchmark. So once we test the strategy and the returns, so how we compare that, how much it is giving in comparison to the benchmark. Suppose the SPY, here the SPY we have taken as a benchmark buy and hold. When we are not doing trading and just holding the SPY, so this our strategy line, the blue line, and the gray line, if you see the benchmark line. So if we hold the SPY, so the returns is lesser than our strategy. So this is the purpose. So when we invest for an algorithm or in a strategy, our purpose it should beat the benchmark. So it is beating the benchmark from 2012 to 2023, and it is with a good gap. Now we'll explore some further points of the metrics. So this extreme market drawdown, as I told, so higher the drawdown, so the strategy takes much larger time to recover from that zone. Here I am showing the drawdowns for each year. These are the different drawdowns. So even in the worst case scenario, it is giving the drawdown of 16%. But for further months also, it is further years, it is less than the 16. Like sometimes 8%, 4%, 10%. But on an average, it is giving 14%. So even in the worst case scenario, 16%, it is not exceeding larger than that. So it shows the strategy recover for further months with its positive return very frequently, and it maintains the drawdown. So this is the USP of the strategy. So even the drawdown is good. The strategy also performed in the extreme market conditions also good. So for example, I will highlight the first event, that is COVID-19 2020. Here the SPY benchmark, if you see it is continuously falling and giving negative returns. So if you have holded SPY, it will give you a larger negative returns with the initial capital. But with this strategy, even it is giving negative, my strategy is giving negative, but with a minimal gap, with very minimal negative returns. So this shows that strategy, even in the extreme market conditions, so it is not giving higher negative returns and maintaining with the proper risk management that Avnish has explained you. And second event I will highlight, that is the Russia-Ukraine to 2020 and 2023. In this case, if you see, even the benchmark, the SPY, it is falling continuously, but our strategy, the blue line, it is continuously increasing for each year. This shows that even in the extreme market conditions, instead of making losses, it is making profit. So this is the unique point of the strategy. And the same way, this AI boom, here also my strategy is continuously giving the positive return, although the benchmark has not given not much more positive returns. So this was in the extreme, all the extreme market conditions like AI boom, Russia-Ukraine war, and COVID-19. Our strategy beats the benchmark in terms of higher the positive returns and less negative returns. So now I invite my colleague Soumyadeep to take here from this, and any further questions answered, you can feel free to ask. Thanks.
Thank you, Pranay. We now come to the end of our presentation, but that's not all. Let me discuss with you our future plans. We have seen that we have been doing data-driven risk management, data-driven Greeks calculation for option strategies. But what if I tell you that these are calculated based on predefined formulas? What if I can make use of the market participants? Imagine that a force and an action. Let's say the force is the placement of orders by big institutions, retail participants, and other players. The outcome of that is the prices being higher or lower. We make use of this data. Using tick data, we integrate order flow, and using bulk volume classification, we create probabilistic buy and sell trade classification. Based on that, indicators are created, and we deploy our option strategies based on the scenario these custom indicators provide. Thank you.
Excellent, guys. Thank you very much. So with that, that was a glimpse of the derivatives, futures and options trading department. Sorry, the Quant FNO, futures and options department, and what they have been up to. So they run two different strategies. One was presented by Abhinav, which revolves around IV rank, IV slope, and the other strategy revolves around Iron Condor, which was presented by the team just now. So thank you very much. I understand this was quite a heavy session. What we'll do now is, before we present the final presentation, and the final presentation is going to be a very interesting presentation, and that's the a prop quant trading. And this time, instead of doing futures and options quant trading, this presentation will be made by Delta One Quant Trading team. Now, Delta One securities essentially are such securities which move in the ratio 1:1. For example, currency, gold, commodities, stocks, etc. So we'll take a 5-minute break after these 2 or 3 heavy sessions, and we'll assemble in 5 minutes from now, which is when our Quant Delta One trading team I would request the team to kindly come forward. All right, there you go. Nitesh, all yours. Take it away.
Slide change. Put the PPT now.
Yeah.
Good afternoon, everyone. So this is Nitish Kumar. So I'm head of product and tech at 2Cents Capital. So today, me and my team here are here to present to you guys our quant trading division. So our quant trading division was one of the earliest divisions we started at 2Cents Capital. Myself, I have been a quant developer for the past 3 years, and I've built over 100 alphas. So today we'll be going through our product architecture for quant trading, as well as what all different kinds of alphas we have worked with, and how we combine all the different kinds of alphas together into one single portfolio. So this is our quant trading division. Our objective is to achieve a market neutral fund. So what is a market neutral fund? A market neutral fund is a fund that is able to achieve consistent returns on all market conditions, be it a bullish market, be it a bearish market, be it a sideways market. A market neutral fund is able to churn returns continuously. So speaking about market conditions, widely there are 6 market conditions: bullish volatile, bearish volatile, sideways volatile, sideways non-volatile, and bearish volatile and bearish non-volatile. So these are the 6 market conditions. And we came up with one single objective, that is our market neutral fund should be consistent and it should be stable and it should be able to generate returns on all these 6 different types of market conditions. Okay, coming back, what is an alpha? Alpha is nothing but any excess returns that you're able to generate over the regular buy and hold of a particular stock or a particular benchmark is what we call as an alpha. Alpha is the technical edge that you're able to gain by exploiting the market inefficiencies. So there are majorly 2 types of alphas. One is time-based alphas and strategy-based alphas. Now again, under time-based alphas, we have low-frequency trading, medium-frequency trading, and high-frequency trading. Coming to strategy-based alphas, we have been working on 4 types of alphas: formalic, technical, machine learning-based, and genetic. So formalic alphas are quant alphas built with complex mathematical equations. Technical alphas are more about technical indicators and traditional strategies which traders use in the market. Machine learning alphas take a different approach of combining various different types of factors, and they get processed through a machine learning model, and the factors are first standardized, normalized, and then we use various types of machine learning models to predict the market returns, to predict the market directions. Further from there, the alpha is generated and trades are taken place. So this is an interesting chart of what are the various different types of alphas we have been working on. So on the x-axis, you see all the different types of market, strategies like trending, mean reverting, breakout, carry on, and event based. And on the y-axis, you see the core different types of alphas like quant, technical, and fundamental. So these are the different types of alphas we have been working on each market conditions. Okay, coming to the point of the market neutral fund and how do we achieve this? So to achieve this, we came up with two main goals. The first goal is diversification. The second goal is uncorrelation. So when you put diversification and uncorrelation together, you will be able to come up with a very good portfolio which has uncorrelated alphas and able to perform consistently on all market conditions. So coming to the first part to address diversification, Quant Delta One Trading Fund operates on all 5 major markets: US equities, Indian equities, Forex, crypto, and commodities. Under each of these markets, we have a bundled portfolios, okay? And each of these portfolios are built with 10 uncorrelated strategies. These strategies, whatever strategies I have been talking about previously, all these strategies are rigorously tested with a rigorous framework. We call it our definition of done. So we'll take a bottom-down approach. We'll start with what are all the different steps we have in our strategy funnel framework, and then we go from bottom to top and show you guys how we are achieving a market neutral fund. Yeah. So now my colleague Shibian will be here to take you guys through the complete definition of done and strategy funnel framework. So this is the exact framework that we follow for every strategy that we create.
Good afternoon, ladies and gentlemen. Thank you, Nitesh sir, for giving me such a wonderful opportunity. So it's an honor standing before you today, this afternoon. So today, in this session, I will be taking you through 2 key aspects that we follow, and that helps us in going through the journey of our quantitative trading process. They are the strategy funnel framework and the definition of done for the whole quantitative trading architecture that we follow. So what is this strategy funnel framework? So the strategy funnel framework is a very systematic approach that we follow to bring live ideas into live trading strategies that go in the real life market. And to test the thoroughness and rigor of this framework, to see how robust the framework is. What is the life cycle of this framework? Will this framework actually work or not? So for all these things are defined by the definition of done. That is the golden standard for our strategy funnel framework. So coming with the strategy funnel framework, so the strategy funnel framework is a 8-layered framework that provides a systematic approach for developing robust trading strategies. So coming to the layer number 1, that is idea generation and research. So this step is the spark of innovation for our trading process. In this step, what we do is all the trading ideas that we decide we will work on comes with a spark. Where the spark is taken from? It is taken from academic journals and research papers, exploring market anomalies, exploring financial charts, where we include all technical indicators, try to find patterns. And in this phase, we try to answer certain questions. Is there enough liquidity in the market? Do we have enough data to go with this idea? Or is the effort actually worth the reward actually worth the effort that we put in for this idea? So after answering all these questions only, the best of our ideas actually pass forward into the next step, that is preliminary testing. So in preliminary testing, it is basically a back of the envelope testing where we create a minimal prototype without diving into much complexities so that we can filter unnecessary ideas. We have an idea by developing a basic prototype, by writing some basics code and testing it on random data. Is it feasible? Is the hypothesis, the idea, the market inefficiency that we are trying to exploit, is it being actually is it logical? Is it actually feasible? All the bad ideas or the not efficient ideas are scraped in this phase. So now, once the ideas are promising, once the idea, the initial prototype is promising, it can give us promising results. So now we have to make that very robust and resilient, that the strategy is resilient in varying market conditions. Suppose now the volatility is low. Maybe you encounter a high volatility market. Maybe there is a lot of selling pressure, buying pressure. Maybe there are some scenario analysis like COVID-19 or a 2008 flash crash. So my strategy should not fail in those cases. It should be robust. It should be resilient. So for that, what we have is the trade and risk management framework. Your strategy should be you should have very reduced risk, and you should have very well exit conditions. Because most of the people, what they do is 99%, many quant researchers spend their time in only finding the entry. But that's not it. Entry should be 33%, and other 33% should be position sizing and risk management. Because in research, it is seen that if you toss a coin, probability is 50-50. If you take trades and you have a proper risk and trade management framework, you are still profitable. It has been proven. So it is very important to have a proper trade and risk management framework. So what do I mean by risk management? Risk management is optimal position sizing. How much risk are you going to take per trade? What position should you have, for that you are willing to lose, that you are willing to risk? And trade management, what I mean is optimal take profit and stop loss conditions. What is the optimal entry or the optimal exit point that you want to define, right? So that your strategy is robust and resilient, and you have minimal losses, and you scoop out the cream, that is the profit. Now, all these frameworks are ready. Now we come to the most important step of our strategy funnel framework, that is backtesting. Now all these ideas, this prototype, this trade management, risk management, all these hypotheses are now converted into well modular, very clean code in our proprietary software, that is Synapse, right? And in this step, we test the strategy for multiple assets in multiple time frames, to see like if it is working for like multiple set of asset classes, like if it is a robust idea, like and we refine the signals, we refine the logic, we integrate more data, we do quality checks, we do slippage. All these things are covered in backtesting. Everything is brought into code. Everything is automated in this process and tested on historical data. Now backtesting is what? It is historical. Now we venture into our process of putting the strategies live, going live. Now after that, our main thing should be the strategy does well in the long run. For that, the strategy shouldn't be overfitted. Like it does very well for the short time. The parameters are adjusted like seems like perfect. But in the long run, the strategy may take a downturn. So what can we do? Like backtesting is all testing, right? But we haven't utilized in the market. We haven't taken consideration transaction cost and other parameters. Like in backtesting, we have taken, but we don't know like how varying transaction cost, varying volatility can affect our strategy. So the strategy now, it can be overfitted. So based on different training and testing samples for the whole backtest period, we try to optimize the strategy and find the robust parameters that provide consistent profit for the strategy for a very long period of time, say for the backtesting period. So that approach, ladies and gentlemen, is walk-forward optimization. It helps us finding the robust parameters that make our strategy free from overfitting, and we get the robust equity curve. Now, once we are convinced with our logics, with our backtesting, with our multi-asset, multi-time frame testing, and we have seen that our hypothesis is working good. And moreover, what we can do is, suppose your hypothesis might not be, it works in all market conditions. So we can do is one more thing in walk-forward optimization step is financial optimization. We take a look, suppose you are using some technical indicators. You take a look at the indicators and the equity curve, and suppose you have the trade book, like the profits and losses that you have made. So we try to see, suppose this was the technical indicator value. For this trade, I have encountered loss. Why I encountered the loss? Was the market volatile? Or was there not enough liquidity that I could not close order? Or was there slippage? Like my signal was correct. Like the algorithm, like the time frame, it couldn't close properly. So there was slippage. So all these things also. So this thing comes under financial optimization. Like what market conditions affected my strategy, right? Now, after we are convinced with all of this, and for this thing, we then put a if condition. Like if this market conditions happen, where my strategy failed, we will not trade. So it smoothens the equity curve. Now, coming to our next step, that is forward testing. Now, once we are convinced that a strategy is good to go, we deploy it in live market conditions in a demo paper trading account and test it for quite a long time, like 6 months to 1 year, to see that in real market scenarios also, it performs well. The execution is proper. There is no slippage. The transaction cost logic that we have taken is like actually follows. Like with incurring transaction cost also, we are still profitable. Then macro analysis. With macro rates, like growing inflation or interest rates, like Nitesh sir told, we invest in currencies. So currencies are affected by interest rates or foreign exchange rates, gross GDP, all factors. So everything is taken into consideration, and all improvements are made in the forward testing phase. Now, once we are convinced, once the strategy performs well, it gives consistent returns, it meets our targets, then we put into implementation, like live market implementation with a small trading capital. And for all the strategies, what we do is portfolio implementation. We have a portfolio of uncorrelated strategies. Why uncorrelated? Because so that the strategy doesn't give the same type of profits or losses in the similar market conditions. Suppose maybe you tell if your strategies are correlated, if they are like the same, and the market is doing good, they are profitable. But when the market takes a downturn, if your strategies are the same, all of them will be making losses. But by having uncorrelated strategies, maybe that strategy for that market condition is not working, but maybe others in that place will make profit. So this is the importance to have very much uncorrelated portfolios. So ladies and gentlemen, this is our entire strategy funnel framework, the systematic approach that we follow. That is a plan for bringing a strategy from a raw idea to the live portfolio. Now, there should be some checklist, right? This is the plan, but I haven't told you the checklist. How will you check the thoroughness and rigor of this framework? So for that, we have the definition of done. That is our gold standard. So in the definition of done, we have certain layers coming to the strategy layer, risk layer, and macro analysis layer. So what are the checklists? So coming first to the strategy layer, we come up with a one-pager. The one-pager consists of the market hypothesis, the data sources, the entry-exit logic, the trade management, the risk management, everything. After we make the preliminary testing, all the ideas are rejected, the most promising ideas are shortlisted. Then what we do is we create a one-pager. Like this will be our plan for this strategy. After the one-pager is ready, we proceed for single asset backtest to see if the strategy is working like fine for a particular asset. To test, make it further. Otherwise, we scrape it. Because if the logic is if the hypothesis is right, then it should work for a certain asset, right? So followed by multi-asset. If it shows like promising results in single asset backtest, we move forward for multi-asset backtest and multi-time frame backtest. So after all these are done, we have very systematic tier sheets. Some assets may perform bad, some assets may perform good, but the strategy is considered when it performs good for a wide variety of assets. Maybe 80% of the assets it perform good, 20% maybe it doesn't perform good. So with the 80%, like majority it is performing good, right? So it is a good strategy. Then, ladies and gentlemen, it is optimized. It is hyperparameter tuned with walk-forward optimization to remove overfitting and make it robust. And after all these checks are passed, like execution, slippage, everything, transaction cost analysis, macro analysis, then macro, though over here is in a separate layer for better understanding. After all these things are passed, the strategy goes for forward testing implementation. Forward testing is putting it in a paper trading account. Now, these things deal with the entry. But what is my risk management? How will I mitigate risk? What will happen in market downturns? So for that, ladies and gentlemen, we have the risk layer, in which we use Monte Carlo simulations for stress testing. Now, what are Monte Carlo simulations and how do we use it for stress testing? So Monte Carlo simulation, it creates random samples of data in which we test the strategy, and we have the equity curve for the training period and testing period. So the training period, the training data is formed by taking different sampling techniques, and we simulate different training periods to get the picture of the testing periods. And in these scenarios combined all, we get an idea of returns distribution, that whether the strategy is profitable or not. So it is very important, and followed by so drawdown recovery analysis. So this helps us improving our stop loss logic and scaling. And moreover, the metrics like value at risk and cumulative value at risk give us the idea of they quantify the extreme scenario, extreme market conditions losses. So all these things are taken into account. And last but not the least, as I mentioned, ladies and gentlemen, we have to take in account the macro factors like inflation, interest rates, GDP, liquidity, etc. And over here, our equity curve is also related to key parameters like volatility and volume. So that overall it is resilient. Suppose your strategy makes 12% and inflation rate is by 9% in your country, or where the investor is. So what is the actual return that you are making, right? So made 3%. So all these things gives us a broader picture, and all these things we want to bring in our picture so that we have a very robust framework. Now, moving forward to the portfolio layer and the trade master layer. So in portfolio layer, we have uncorrelated strategies so that the strategies don't have a, say, similar upturn or downturn and the portfolio is robust. That's why uncorrelation is given a lot of weightage. And we have coverage across like 5 different sectors: US equities, Indian equities, currencies, cryptocurrencies, and commodities. So it helps us to make a diversified portfolio of delta 1 assets. Suppose like Indian equities, it is not performing that good, right, in current times. Maybe US equities, it is performing very good. So if Indian equities don't perform well, maybe US equity can cover up for it, or cryptocurrencies can cover for it. So we have uncorrelated verticals and as of now, and we also go for covariance and correlation analysis of the returns for strategies to make a very optimal and robust portfolio, followed by portfolio optimization techniques that my colleagues will come up with. And coming to the last but not the least, we have our trade master layer, because like in 2Cents, what like Synapse is trade master. So whatever we implement is implemented, the quant trading strategies are implemented through our proprietary trading software, that is trade master. It is the one-stop solution for backtesting, hyperparameter tuning, forward testing. So in this layer, the risk management teams make risk management models and trade management models. So for the strategy, we test with various risk and trade management models and select the best risk and trade management model for the strategy that gives us the best result. So this is the importance of the trade master layer. And after all these checks, after passing through all these layers, if the strategy is resilient and it performs good in all varying market conditions, then only we take the strategy forward. So now, ladies and gentlemen, that's the art of quantitative trading for you guys. So in this, we mix up intellectual thinking, mathematics, and technical coding, and bring you guys very robust, high-performing strategies that provides us consistent returns. So now I pass it to my colleague Abhilash, who will be taking you through the risk management framework. Thank you.
Hello. Thank you, Shibayan. Ladies and gentlemen, thanks to you as well for being present over here as we unveil our new product that is being launched by a venture which is being built on the foundations of rigorous analysis and robust risk management framework. In today's financial landscape, as you can see that new HFTs and hedge funds are coming up. Every now and then, geopolitics is taking turns, and hence volatility and uncertainty are inevitable. So what can we do? So the answer is, with the help of Quant Trading team, we have the right tools not just to mitigate the risk, but generate profits from extreme scenarios. For all of you sitting over here, like, you guys are not investing some pennies. So risk might be the most crucial factor that you are looking for. This is not something that is unavoidable. I myself, Abhilash Khattar, will take you forward with the risk management framework that we as a Quant Trading team follow with extreme discipline. So the first and the most crucial pillar that we follow is correlation and diversification. Diversification, correlation seems a very fancy word, right? Let me give a fancier definition. It's a time-tested strategy that safeguards your investments from sudden market shocks and also generates profits side by side. Very fancy one of you, can you please close your eyes and think about the stock market crash of 2008? That was a financial crisis, right? Now imagine if your portfolio would have been there at that time, filled up with the US financial stocks. How would your portfolio look like? Brutally red, right? It would have been completely nil, right? So now, like, what can we do with this? How can we avoid this? So the answer is the same, diversification. If your portfolio comprises of the stocks and equities, which are from different asset classes, different geographies, different industries, then your portfolio would have been much more resilient to those financial crises, right? Now you think, does this term of diversification applies to just your portfolios or to our strategies as well? It applies to our strategies as well. Our quant trading team does not work just on a couple of strategies. We work on hundreds of them. And each of them is designed to identify unique market opportunities to draw profits. Now let's say we have two strategies A and B, which are extremely correlated and are dependent on the interest rate of the Federal Reserves of US market. Now, if suddenly the FOMC committee decides that overnight we'll raise the interest rate by 2%, high chances that both of the strategies will incur losses, heavy losses, right? So what's the solution for this? We pair two completely uncorrelated strategies. That is, one based on interest rate and another based on momentum or arbitrage or something else. So that was all about correlation and diversification. I was able to explain you diversification and how important it is for our team. Okay, let me come to a very crucial pillar of our risk management framework, that is value at risk. I can see very knowledgeable people over here who have come with different backgrounds. So I think many of you might know what value at risk is. But if still you don't know, I'll explain. It's an answer to a very critical question. And that is a very critical question to all the investors. And that is, what's the worst case scenario for my investment and how likely is it to happen? Sounds fair to an investor, right? It all comes to your mind, right? Let me repeat it. What's the worst case scenario for my investment and how likely is it to happen? It's like a probability game. And what's the answer? It is value at risk. It is a powerful statistical tool that our team uses to identify the amount of risk that our strategies carries with the help of assets. Let's take an example. Let's say there's a value at risk of $1 million at 95% chances. What does this mean? It means that there is 95% chances that the maximum loss won't exceed $1 million in a given time frame. And only 5% chances that it will. It sounds fair to an investor, right? If you are investing, you should know that how much risk are you taking? How much money is at risk? How much can a team lose? Fair, right? This is what all value at risk does. Now let me take you to one more crucial pillar, that is stress testing. It's a very simple word. I guess all of you understand what does stress and testing means. It is like a fire drill in your offices or in your apartments or somewhere. You might have conducted a fire drill at least once, and all of you might have always come up with a question that what's the need for this? I mean, it's 99% chances that fires won't happen. Why are we doing this? But still, you guys do it. Why? Because there's 1% chance that fire will occur, and it has the potential to destroy everything, right? Same is the case with stress testing. Let's imagine that the buildings and infrastructure is like your money. We don't want to risk your money even for the 1%. We can't risk it. Let me give an example. Do you guys remember the stock market crash? It is famously named as the dot-com bubble burst, which happened in the year 2000. It was a sudden overnight crash, which happened due to investors pulling out money rapidly from the tech portfolios. It is something very unpredictable, right? It's not something that we can predict that, oh, this might happen tomorrow, let's withdraw our money. So how do we prepare for these scenarios? The answer is stress testing and Monte Carlo simulation. This graph, this chart, what we present over here is Monte Carlo simulation of one of our strategies. Each and every line, what you see over here, is a simulation of some scenario. Monte Carlo simulation helps us to simulate various scenarios across various conditions and help us to identify vulnerabilities in our own strategy. If we can find vulnerabilities, then we can fix it out and then trade it over again. So this is one of the chart. As you can see, that after a lot of testing, in all other scenarios, the returns have been positive. In no scenario, the returns have been negative. That is what all stress testing does. I think I spoke a lot about risk management. That was all just the brief introduction, but I like to ask one question to all of you guys. What, according to you, is the biggest risk that you can take? Just think about it for a minute. My own answer is that the biggest risk you can take is not taking any risk in the market. That's the biggest risk according to you. Now, I'd like to pass the mic to continue further to Nitesh, sir.
Yeah, thank you so much, Abhilash. Okay. So now, over all the different types of alphas that we discussed, now we selected the best, selected the alphas with best risk management and best trade management, and we put it through the complete definition of done which Shivan presented, and we made sure it satisfies all the risk management which Abhilash presented, and that's how we came up with one single strategy. So once we rinse repeat this complete process, we'll be able to come up with several strategies. So that's how we came up with a basket of strategies. In our case, we came up with roughly somewhere around 100 strategies, and we wanted to bundle them together as a portfolio. So to do that, again, the approach which we took was the same approach which I pitched earlier: diversification and uncorrelation. We wanted to make sure that the alphas that we were running, it needs to be always on the top of the game. So to do that, instead of doing hyperparameter tuning, we did walk forward optimization. So this current week, on this current market condition and this particular week, what are all the alphas out of our basket of alphas is performing good? We shortlisted them. Now we come down to a universe of 100 to 25. So from this 25 alphas that are performing good, performing extremely good for this particular week, now we make a portfolio of 10 strategies which are completely uncorrelated to each other. So the benefits of having a portfolio of uncorrelated alphas is, in terms of market downturn or in terms of market crashes or volatility, all of your 10 strategies would not perform bad. Some may perform good, some may perform bad, even in the extreme case scenario, because everything is uncorrelated to each other. So that is the thesis we came up with. It is backed by research, and that is how we came up with our portfolio construction. So coming to the uncorrelation bundle, now you have an uncorrelation bundle of 10 strategies. Now if you plot the correlation matrix, we make sure that the strategy-wise correlation is less than 0.6 and the overall portfolio's correlation is less than 0.4. Okay. Now this is how we come up with the 10 uncorrelated strategies. We bundle it together as one single portfolio. So now it goes to the next layer. For each of these markets, our plan for the next 6 months is to expand these portfolios into multiple portfolios. How we came up with one single portfolio for US equities, we are planning to do it. We are planning to have multiple portfolios under US equities which satisfies all these conditions. The same model, now you do it on Indian stocks, you get it for India, you get a quant trading fund for Indian portfolio. The same applies for Forex, crypto, and commodities. So once this vision of uncorrelated portfolios and strategies are achieved, so the main question arises about how do we allocate our funds? So let's say roughly $1 million enters our Delta One quant trading fund. How does it get split across all the 5 different markets so they are diversified, and how they are split across all the different uncorrelated portfolios under each market and all the different uncorrelated strategies under each portfolio? So to solve this is where portfolio optimization comes into play. And now Aryan Raj Singh will be taking up how we do portfolio optimization.
All right. Hello. Good evening. Good afternoon, everyone. Myself, Aryan Raj, and I'll be taking you through our team's portfolio optimization policy. So, what would you consider the hallmark of a great portfolio? Will it be consistent growth? Will it be minimal risk? Or will it be adaptability? I think a great portfolio should have all these 3 things. Okay, so before I take you through the framework, I'd like you to imagine this. Imagine you are sailing in an ocean on a ship. So there will be days when the water is calm, you'll be throttling ahead at full speed. But there will also be days when there are storms and high waves and you are struggling to stay afloat. Well, a well-built portfolio is like a well-built ship. It keeps you steady in rough water conditions and also allows you to move ahead at full speed when the conditions are favorable. All right. Our team doesn't build ships; it builds fleets. Each of which is designed to any actions. All right. So begin. So the allocation, the optimization process begins with intelligent asset allocation. Asset allocation is the foundation of a successful portfolio. And how do we do it? We analyze historical returns, we analyze market correlations, and we analyze market dynamics to adjust weights across the strategies. But so here's an example of how we do it. Let's say there's a strategy which is outperforming in certain market conditions. So what we do is we will allocate their capital to that strategy in those conditions, but we won't just stop there. To avoid any over concentration, what we'll do is we'll also diversify the portfolio with other uncorrelated alphas. It's like a balanced diet of the portfolio, some risk for growth and some stability for resilience. Next thing is adaptive boundary constraints. So we have performance benchmarks as dynamic boundaries. So here's an example. If there's a strategy which is underperforming relative to its peers in the market, what we'll do is we will replace the strategy seamlessly and quickly, and while maintaining the same risk profile. So what this does is this ensures that the portfolios remain optimized for growth. Next thing is, next step is robustness testing. So, well, the ships need to be prepared for all weather conditions, right? This is where it comes in. So our strategies are tested under various market conditions. We have thorough testing framework. For bullish markets, we simulate 20% uptrend to evaluate growth potential of the strategy. For bearish market, we simulate 25% downturn to assess the loss mitigating mechanisms of the strategy. And for sideways markets, we have periods of low volatilities to check for any unnecessary trades or costs that are being made. And there are also extreme scenarios, right, other than this. So we also test our strategies for liquidity shocks and volatility spikes and maybe some black swan events as well. So it's like whether there's a storm or smooth sailing, the portfolios are built to endure everything. Next thing is data-driven decision making. So here's a fun fact. 90% of the world's data was created in just the last 2 years. So that's amazing, right? There is a lot of data available everywhere. So the challenge is how to use them. So that's why we have machine learning models. So what we do is we use machine learning models to uncover hidden patterns that might be key performance drivers. For example, we developed algorithms to detect early signs of underperformance that help to make time adjustments so that the portfolios remain profitable and balanced. Now, another thing is, next step is transparency. So transparency is the key to building trust. That's why our team will be providing clear and actionable reports that will include these 3 things, which is backtesting results over 20 years and walk forward optimization reports that helps us to check for the strategy's adaptability in real life scenarios, and overfitting bias report to check for robustness, right? And now the next step is continuous improvement. So how often do you reassess portfolio and strategy in markets? Is it monthly? Is it quarterly? Or do you do when something goes wrong? Well, my team wait for for problems to arise. That's why we have continuous monitoring and improvement. We monitor the portfolios in real time, and we data and we keep making adjustments. Well, we all know that the markets evolve, and so do our strategies. We have regular reviews and feedback loops to ensure that the portfolios remain optimized for growth and resilience. Well, building a portfolio is not just something about today, it's about building something that lasts. My team combines all these steps to deliver exceptional performance with minimal risk. All right. So now Nitesh sir will take us through some of our results.
Yeah. So we started with ideation, then the strategy gets developed and it passes through our definition of done and strategy funnel framework. And we rinse repeat this process and we get a lot of alphas, and then we make uncorrelated portfolios out of them. And this is the return curve of one of the portfolios where you have the cumulative returns against the benchmark. So the yellow line that you're seeing here is the benchmark of S&P, and the strategy that you're seeing here is the continuously walk forward optimized equity curve of each strategies and how we bundle it into a portfolio of uncorrelated alphas. So that's it for today. Thank you so much for listening, guys. So we'll be, yeah, I thank every one of you guys for listening to us so far, and I wish you all a very happy Independence Day. Thank you.
Thank you very much, guys. It was very well done. Okay, with that, we have come to the end of our sessions, the 2-day sessions of product reveal. It was an exhilarating session, fantastic feedback. A lot of good response has come. Now people are more aware of what we have been up to. Going forward, we have a very long roadmap. It's a very exciting journey that we have embarked upon, and we are very hopeful and very excited that we are going to turn a lot of what we have just said into brilliant products, and very soon we will be exposing these products for proper usage to everybody. Thank you very much for joining us. It was a pleasure, and I thank you all on behalf of the entire 2 Cents family for joining us on this endeavor. Thanks a lot. Thank you very much.